March 2023, Silicon Valley Bank goes from healthy to dead in 48 hours. $175 billion in deposits frozen in a bank. The safest possible place to put money. That same week, Warren Buffett's Berkshire Hathaway was sitting on over $100 billion in cash and short-term treasuries. Not in stocks, not in bonds or real estate. Treasury bills, short-term government paper that most people associate with retirees. The boring move. The one nobody was writing articles about. He wasn't hiding from risk. He was positioning. That word, positioning, is doing a lot of work. It means he had already decided, before anything visible had gone wrong, that the next 18 months would produce a buying opportunity he couldn't afford to miss. The capital was accumulating for a reason. It just hadn't been deployed yet. The pattern holds across every major crash in modern finance. Before the bottom falls out, ultra-high net worth portfolios start moving, quietly, into assets most people don't recognize as assets at all. By the time the crash hits, by the time your portfolio is down 40%, and the news is screaming, they're not running from the fire. They're walking through it with a shopping list. This is unpriced risk. Everything made sense, right up until it didn't. Their positions are filed publicly every quarter, and almost nobody reads them. 5 assets show up on those lists across every major crash in modern finance, in SEC records, Knight Frank wealth reports, bankruptcy court filings, and private acquisition databases. One of them you can open in a brokerage account today. One requires understanding how bankruptcy courts actually work. And the last one is the reason the Forbes list looks almost identical after every crash, just with different names at the top. There's something buried inside every crash that's ever happened. Nobody leads with it. Crashes don't destroy wealth, they relocate it. When the S&P dropped 57% between 2008 and 2009, those trillions of dollars didn't evaporate, they moved. From the accounts of people who panicked to the accounts of people who had prepared. From dispersed public shareholders to concentrated private capital. From the seller at the bottom to the buyer with positioning. The logic is simple. Crashes require sellers. Sellers need buyers, and buyers need cash and the right assets. The people who enter a downturn already holding things that keep their value are the ones with purchasing power to buy what everyone else is throwing away at 30 cents on the dollar. In 2020, farmland barely moved, while the stock market fell 34% in 23 days. Not luck, structure. In 2009, private equity was acquiring essential service businesses at 40% below pre-crisis valuations, because they had planned for exactly this. The 5 assets coming up aren't all defensive positions. 2 hold value while everything else falls. The other 3 are offensive. They're how new fortunes get built, not just preserved. And the split between those 2 categories matters more than most people realize. Wealth preservation and wealth creation require completely different assets, and the people running serious money know exactly which is which before anything goes wrong. Buffett was buying T-bills. Marx was reading bankruptcy filings. Gates was buying farmland. None of it made the news. That's the other thing worth noting. The moves that look the most boring in a rising market tend to be the ones that look like genius 18 months later, not because of luck, because the person making them understood which environment they were actually in. Start with the boring one, short-duration government paper. Buffett went from around $130 billion in cash and short-term treasuries at the time of the SVB collapse to nearly $170 billion by end of 2023, then over $270 billion by mid-2024. The financial press spent 3 years calling it cowardice. Too conservative. Missed opportunity. They got it backwards. Treasury bills aren't a place to park money waiting for something better. They're purchasing power held in its most convertible form. The ultra-wealthy don't treat cash as something that costs them yield. They treat it as the only asset that converts into every other asset at the exact moment those assets are cheapest. Think about what that actually means in practice. In a normal market, cash earns less than almost anything else. But in the 18 months after a major dislocation, when equity prices are still recovering, when distressed businesses are available at discounts that won't last, cash is the single highest returning asset in the world, not because of what it earns sitting still, because of what it can buy when everything around it is bleeding out. Buffett has said publicly, more than once, that he treats Berkshire's cash position as an insurance policy, not for the company, but for the opportunity. The payout only comes if something breaks, and something always eventually breaks. Hold $10 million in T-bills. While markets fall in half, you earned $400,000 and still have $10 million to deploy when extraordinary businesses are selling at half price. The person who was fully invested, forced to sell at the bottom just to cover their obligations. Asset 2 is the one almost nobody explains clearly: distressed debt. When a company nears bankruptcy, its publicly traded bonds collapse. A bond at 100 cents on the dollar might trade at 15, sometimes 10. Nobody wants it. That's precisely when Howard Marks walks in. Marks built Oak Tree Capital almost entirely on this thesis. In October 2008, while markets were in freefall, he sent a memo to clients. Distressed debt isn't a gamble on survival. It's a legal mechanism for taking ownership of a company's assets at a fraction of their replacement cost, without paying equity price. In March 2020, he sent almost the same memo. Different crisis, same logic. The window was always shorter than it looked. The people who were ready had been ready for years. When a company enters bankruptcy, the court restructures it. Old equity gets wiped out, shareholders receive nothing, but investors who bought distressed bonds at 15 cents receive new equity shares in the reorganized entity. They bought debt and emerged as the new owners. April 2009. General Growth Properties, second largest mall operator in the U.S., filed for bankruptcy. Its stock had collapsed from 63 to 34 cents. Starting in early 2009, months before the filing, Bill Ackman's Pershing Square had been accumulating both equity and deeply discounted bonds, paper that larger institutions were exiting at any price. When the company emerged in November 2010, that position had returned more than 20 times its cost. The records are public, filed with the court. There's a reason this doesn't show up in the financial advice most people receive. SEC Regulation D, the federal rule governing private investment offerings, requires a net worth of $1 million, excluding a primary residence, to participate in most distressed debt funds. That threshold excludes more than 80% of American households, not because the concept is too complex to understand, because the law says they can't participate. The barrier isn't the idea, it's the entry ticket. If you want to keep following this breakdown, subscribe now. We pull apart these mechanisms every week. The next one drops soon. Asset 3, productive agricultural land. Between 2000 and 2020, prime farmland in the United States more than tripled in value. It didn't crater in 2001, 2008, or 2020. Through every major financial dislocation of the last 2 decades, it held. Through the entire 2008 crisis, while equity markets were being cut in half, farmland was essentially flat. The reason is structural. People have to eat, regardless of what the Federal Reserve does. A farm generating calories doesn't respond to monetary policy. And unlike financial assets, you can't print more productive agricultural land. Its supply is finite and declining as urbanization expands. What makes the asset particularly interesting in an inflationary environment is the lease structure. Agricultural cash rents, what tenant farmers pay to work the land, are typically indexed to commodity prices. When inflation spikes, grain prices rise. When grain prices rise, the cash flow on a farmland lease rises with them. The asset that looks boring in a bull market becomes the inflation hedge in exactly the environment where everything else is struggling. It doesn't just hold its value when prices rise, it generates more cash. The Knight Frank Wealth Report has tracked the farmland index for over a decade. Not once did it go negative during a crisis. Not 2001, not 2008, not 2020. Bill Gates is the largest private owner of farmland in the United States, over 270,000 acres across 18 states, accumulated since 2013. His office doesn't comment publicly on the rationale. They don't have to. The investment thesis isn't complicated. Between 2001 and 2016, the United States lost approximately 11 million acres of agricultural land to development, urbanization, and conversion, roughly 1.2% of the total. The trend has not reversed. The population that depends on that land to eat continues to grow. At some point, basic supply and demand does the work that all the financial engineering in the world can't replicate. Asset 4, blue chip fine art. This sounds like a lifestyle asset. It isn't. Research tracking the art market through the 2008 crash found that when equity markets lost more than half their value peak to trough, the top segment of the art market, the most established, auction-verified works, declined only modestly in comparison. The divergence wasn't coincidence. It reflected a structural property that financial assets don't have: None of this has to do with aesthetics. It has everything to do with supply rigidity. A Gerhard Richter painting can't be manufactured by a central bank. There's no art equivalent of quantitative easing. The supply is permanently fixed. Richter made his last oil paintings in 2017. No new canvases are coming. In an environment where the Fed expanded its balance sheet by $3 trillion in 2020, fixed supply is structural necessity. Public auctions are price transparent. Private treaties, the channel through which most serious art transactions occur, are not. And the dynamics of a private treaty during financial stress are worth understanding. The seller is typically someone who needs liquidity to cover losses elsewhere, a hedge fund manager whose portfolio is underwater, a family office facing redemptions. They can't wait for the right auction date. They need cash now. The buyer acquires a work at a discount that will never appear in any public index, never be tracked by conventional financial reporting, and never trigger a margin call. The transaction is invisible to the market. The opacity isn't a side effect, it's the point. Asset 5, this is the offensive one. The first 4 preserve wealth during crashes. This last one's different. It's how entirely new fortunes get built during economic downturns. Not preserved, built. Essential service monopoly businesses. After every major economic crisis, private equity data shows a pattern so consistent it looks programmatic. In the 12 to 36 months following a dislocation, sophisticated capital targets businesses in sectors with inelastic demand: waste management, self-storage, funeral services, pest control, water infrastructure, medical waste processing. Every one of them has the same characteristic. People cannot stop using them regardless of economic conditions. A family that's lost its income still generates garbage, still needs pest control when the infestation arrives. Death during a crisis operates entirely independent of central bank policy. What's almost perverse is the economic profile under distress. Revenues stay stable. Labor costs fall as unemployment rises and workers lose negotiating leverage. Smaller competitors, the ones using debt to fund expansion, default. It then buys their routes, contracts, client lists, and equipment at liquidation prices from operators who can no longer service their obligations. The industry structure matters here. In essential services, local operators typically serve fixed geographic areas, routes, territories, catchment zones that can't easily be replicated. When a small funeral home or waste collection company goes under, its clients don't disappear. They need the service tomorrow, same as yesterday. The acquirer isn't just buying equipment. It's buying a captive customer base with nowhere else to go. In industries with high switching costs and low alternatives, that's not a customer list. It's a recurring revenue stream with a lock on it. Wayne Huizenga never called it a crisis strategy. He founded Waste Management in 1968, took it public in 1971, and within a year had completed 133 acquisitions, building a national network before the economy had time to punish anyone who hadn't prepared. No disruption thesis, no technology edge. Garbage trucks drive the same route whether the economy's growing at 4% or contracting at 4%. He held the monopoly when the economy recovered and repeated the cycle in every subsequent contraction. Then he ran the same roll-up logic with Republic Services in the mid-1990s, same fragmented industry, same acquisition structure, proving the playbook didn't require a crisis. It required fragmented sellers and inelastic demand. Private equity data confirms the pattern in every cycle. Between 2009 and 2012, institutional capital accelerated its acquisition of essential service businesses, funeral homes, storage operators, water treatment companies, buying at depressed multiples while their underlying cash flows remained entirely intact. Glamour during expansion, monopoly during contraction. The sellers in those transactions are worth understanding. They're typically not naive operators who didn't see the downturn coming. They're operators who used leverage to grow during the good years, debt-financed acquisitions, equipment financing, working capital lines that made sense at 4% interest and didn't at 8%. When credit tightened, their fixed costs became crushing. They weren't bad at running the business. They were bad at balance sheet management. The acquirer buys the operating business, the routes, the relationships, the recurring contracts from someone whose financial structure failed, not their service. The underlying cash flow was always there. Every major economic crash in modern financial history has not been a random natural disaster. It's been a predictable redistribution event. Capital moves from the unprepared to the prepared. From the panicked to the patient, the person holding what everyone told them was safe ends up on the other side of the transaction from the person who spent the last few years quietly making sure they wouldn't be. The mainstream financial system told you that safe means savings accounts, bond funds, and a diversified portfolio. Not wrong for people who need liquidity, but it's advice that was never designed to build generational wealth. It was designed to keep capital available for the institutional buyers on the other side of those trades. That's the deeper structure nobody names clearly. The architecture wasn't built by malice, it was built by assumption. The assumption that this level of information is only actionable for people who already have access to these vehicles. That assumption is false. The principles aren't vehicle specific. Understanding how distressed debt works doesn't require $1 million. Understanding why farmland outperforms during inflation doesn't require 240,000 acres. Understanding that Buffett's T-bill position is a positioning statement, not a sign of pessimism, that's free. The knowledge isn't gated. The entry ticket to the specific vehicles is, those are different problems, and only one of them has a legal solution. When the next crash arrives, and the cycle is the most reliable pattern in 150 years of modern finance, there will be two kinds of people in that transaction: the ones selling because they have to, and the ones who spent the last few years quietly making sure they wouldn't be. Buffett filed his position publicly, every quarter, for 30 years. The form is called a 13F. It's free to read. If you want to keep following this investigation, the next one drops soon. Thanks for watching Unpriced Risk. Hit subscribe and we'll see you in the next one.